Welcome to the Credit Events Podcast, a podcast for credit-savvy investors. This podcast is for informational and educational purposes only and does not constitute financial advice. The opinions expressed by the presenters are their own and do not reflect the views of Destra Capital Management. Nothing discussed in this podcast should be considered a solicitation to buy or sell any securities. Listeners are encouraged to consult with a qualified professional before making any financial decisions. And now, here's your host, Rob Watson.
All right, everyone. Well, welcome back to the latest edition of Credit Events. It is Thursday, March 13th. I'm Rob Watson, and my guest today is Joe Smith, who is a co-founder and chief investment officer at Parti, which is a customized wealth tech platform. They're doing some really great stuff in that space. And Joe, we're just really excited to have you on Credit Events. Thanks for joining us today.
Yeah, thanks for having me, Rob. It's great. It's a great rainy day here in Seattle, so looking forward to it.
How's that different than most days in Seattle, right?
Exactly. Not
well,
very different at all.
Before we get started, this is a little awkward. Can you actually move your camera a little bit so I can see that painting or that picture above your head behind you? You're not going to believe this. I don't know what this is. This is a weird thing in the universe, but I'm going to step aside right now.
Oh my gosh.
Check that out. Now,
exactly.
I don't know. Maybe yours was like a replica that you got in Holland when you were touring an art gallery or something. Mine was done when my kid was like in third grade, and each strip of that is like one of the kids in the third grade class, and then we glued them all back together, and then I way overpaid for it at a silent auction for the school. So that's how I got that lovely piece of artwork hanging in my. But that's kind of freaky, isn't it?
That is a little bit freaky, but maybe that's just a precursor of what's to come today. So
yeah, exactly. Maybe it is. Maybe it is. There you go. Okay. All right. So look, most of our guests on Credit Events are portfolio managers or analysts or traders or whatever that are working in the mechanics of the bond game. Usually, corporate credit tilted. That's why we call it Credit Events, obviously, right? Yeah. But I was really excited to have you on today because I think you've got a completely different look at how people, investors in particular, and financial advisors are going to access credit, because you're living in the cutting edge, some would say the bleeding edge of the technology world, and bringing new tech to the space, which is really upending the way that financial advisors can custom build portfolios for clients. And one of the things that I'm curious about is how will credit instruments, bonds and loans themselves, and also packages of bonds and loans, how will those things play a role in that? How are they going to fit in that? I think it's fascinating. I'm really kind of excited about it. And so we're thrilled to have you with us today. So
yeah. So this is actually a topic that's near and dear to my heart, Rob. And, I think what I'll probably say first is that, credit, fixed income overall is going to be an even more important consideration as we move forward, relative towards kind of, where we've been over the last couple of years with, the ongoing rise of the equity markets, the Magnificent Seven, whatever, acronym you want to apply to it. I think the reality is that we're at a stage now where it's not just simply credit, but I think fixed income in general is going to become an even more important consideration for how people build more customizable portfolios for clients. Overarching with that, I think, which is driving some of the demand and interest on the technology, is really, you've seen a lot of the surveys out there, whether it's from Cerulli and others, who have talked about this migration of assets from baby boomers to their children over the next 2 or 3 decades. Could possibly represent between $70-80 trillion in terms of wealth that's transferred. And I think the reality, though, is that still for where a lot of those clients are today, is that they still need to address the challenges with, if they're near at retirement or in retirement, how they may think about, funding their lifestyle choices or other, things that might be important to them over the next, few decades. How they may also think about, bequeathing some of those assets to their children as well, and really kind of balancing out, what's the implications both in terms of risk and return space versus cash flow, right, generation, relative towards kind of those objectives overall. So, from our vantage point, number one, I think that's going to be a really big overarching trend. The second piece with that, though, is that people are just a lot more concerned about taxes, right? Obviously.
Always, right?
Right. We're always trying to see if we can save more, right, relative towards kind of what we pay back to the government. And so, coincidentally, in my world at least, the technology to really optimize around, someone's tax liability is becoming a very important consideration. And that's not just for equities only. It's certainly, fixed income plays into that as well. And the third piece of it is that, for a lot of the advisors out there, probably even the ones listening in on this podcast right now, you know, the value add that's getting created through, financial planning, investment planning exercises really is kind of the stage one that then, helps to facilitate. So what do I need to do when it comes to implementation? So, we see a really, really big trend and focus in relation to that, where folks are going to be migrating and using householding, right? It's not a new definition of something, but really having the technology to actually scale householding as an approach towards managing client wealth, I think is going to be even more important than it's been historically. And so you put all those components together, I think it just naturally kind of gravitates back to people need to build outcome-based portfolios or goals-based portfolios. They need to think about implications of cash flows and timing of cash flows. And they need to think about kind of how they balance out risk, right? Which all points back to fixed income and also within that credit, more specifically.
Joe, you mentioned householding, and I'll tell you, I'm not kidding. 30 years ago, right? More than 30 years ago, when I was getting started, yeah, we would household the account, right? We would. I'm not joking about this.
Yep.
We would get the statement from the life insurance company. We'd print off the checking account and the savings account statement from the bank. Then we'd print off our own brokerage account statements with 3-hole punch them all, give them each a tab, put them in a binder, and then when we go to the client review, we would household the client, and that would effectively be it. And the thing I'm so excited about is the kind of technology that you guys have designed and developed and that others have in the market space today. We're finally going to not just gather the screen scrape and gather the data. We're actually going to take portfolio actions at the householding level. And I was wondering if you could kind of talk a little bit about that. And of course, as always, we've got an axe to grind here with the idea about credit utilization. But how does credit fit in that?
Yeah, so I probably would say the biggest enhancement we probably had since probably your days, Rob, of kind of going through that exercise has been
My days, way back in the dark ages.
not too long ago, but maybe a little bit back in the day.
In a land
certainly
far, far away.
Exactly. I think it, at best, for a lot of advisors out there, that exercise is probably still more in spreadsheet land, right? With Microsoft and Excel and things like that, right? Which in some respects, I think we all could now say we are probably Excel geeks, and that's the way we like to consume information when we're trying to do these type of things. But it also, especially for the folks out there that do this on a daily basis, it's very time consuming, right? So how do I need to think about, reallocating my client's wealth when they could be transitioning in with a new set of accounts, right? That decision making can be pretty tedious, right? If you're trying to, compare tax lots or positions between accounts and think about kind of, what's the best way to balance out both risk, minimize tax liability, and possibly even, work around securities that may not be something that you think that you're going to be able to, accurately trade because of liquidity issues. So, when we put it back in terms of like credit, credit has a place, an important role. I think often when we talk about, householding and the building of householding portfolios, right, to, really allow for the technology today, which is, basically making simultaneous trades, around all the accounts is, I think the thing that is always ongoing is that friction between how do you think about allocating the credit from a risk standpoint? How do you think about the implications of your holding period from a tax standpoint? And then how do you think about your withdrawal considerations from a liquidity standpoint? And so the technology's come a long ways from that, right?
Yeah.
I think we all are still kind of grappling with how to do that more efficiently and scale it.
And I also think one of the things I know the marketplace is excited about is that the technology is getting so good, frankly, that you're able to take what was once offered only to the absolute wealthiest of wealthy clients in, ultra high net worth shops or the pinnacle of private banking kind of work, right? But the technology now brings that down market a lot. And if things are listed equities, ETFs, maybe mutual funds over, still trade OTC, but every day you can do them on the wire, right? There's an efficiency in that. A lot of credit instruments um, are tough to trade for people that only have a million or less, let's say, or even 2 million, but maybe not all of it is oriented at credit. Maybe half the portfolio is off in stocks as it should be, right? How do you address that in the technology, and as you come down a little bit, how do you still bring the skill set and the capability to people, but at a smaller scale?
Yeah, so I think it really depends upon let's call it the client persona or profile, right? That we might be working with when it comes towards the application of technology to do that. So for some of the clients we work with today, right, they think about this in the context of, given that they are working directly with the family in a lot of cases, they're going to take the time to figure out which specific credits, which specific issuances do they actually want to hold on behalf of their client, right? And especially when tax implications could be at the forefront of that, and municipals need to come into focus for that. I think they're very laser focused, if you will, on ensuring that they have the right credit profiles and issuances to allocate to in the portfolio, right? And where we make that very efficient, though, is that we really allow them the ability to provide inputs for controlling what goes in and out of the portfolio. Being able to reflect cost implications for actually trading that. So it's not just simply, here's what's stated in the model, go out and purchase it. It really can give more choice towards thinking about kind of what's going to be most efficient from a liquidity standpoint, a tax standpoint, and getting to kind of the overall risk profile or neighborhood you want to be in when it comes to diversifying or using those securities to also diversify the portfolio.
Can you talk a little bit about? I know that there's an awful lot of customization today in the ETF space, specifically for model development design. Really creative ETF providers are creating a specific or unique element of a model. How do you wrap that into the technology where you say you're bringing in, I don't, whether it's direct indexed or whether it's even an active SMA manager, maybe you're bringing in the equity side here, as you talked about, maybe you've bought the muni bonds themselves, but there's this other piece, credit, right? Where you say, you know what, at 2.5 million, even 3 million at your portfolio size, Mr. or Mrs. Client, here's some ideas of how we can still get you credit exposure, but we may not necessarily be buying the specific bonds because it's going to be tough to buy them off the run or in small chunks sometimes.
Yeah. Yeah. So that actually speaks to probably, what I'll call the second client persona that, or client profile that we see in terms of working with. What I love about what's happened in the ETF space is that we've kind of gone from vanilla chocolate and strawberry. Folks probably remember the days of it was largely just State Street, iShares, Vanguard, right? For better, for worse. Um, to really kind of giving you choice around like how you may want to target your credit exposure in the portfolio. So whether it's bank loans, whether it's CLOs, whether it's even private credit, right? In a lot of instances, or different kind of nuances relative towards kind of where you may want to be in terms of credit quality, right? All of those choices exist now to make it a little bit more efficient, if you will, for the advisor to decide how they want to kind of create their solution for their clients. So from a technology standpoint, we support a lot of our clients in the ability to represent those as being investment options or choices when they apply it in more of a holistic optimization framework. I think the other pieces that come in the focus for some of those folks as well is really thinking about kind of, again, this probably more so and for lower quality credits than anything else, is how much might there be overlap from a risk standpoint when you think about those type of securities relative towards the equities as well. So the great thing with the technology now is that it takes care of a lot of that decision making for you, so you're not having to kind of guess or think about it relative towards looking at the data and multiple spreadsheets, if you will.
We've been sort of referencing the technology, and you just mentioned it again. Can you maybe take a step back and talk to us about, I mean, the underlying this, a lot of times people call this direct indexing or custom portfolio design. You actually talk about what is the baseline of the technology we're talking about, and maybe even more interesting, what do you see on the horizon that you think we would want to know about?
Yeah, so I think when people talk about this technology, it's really behind the scenes. We're talking about portfolio optimizers, right? In a lot of cases, and the way that those tools look at and kind of break down risk, largely in the way that we all talk about, our portfolios today. We just don't realize that some of that can be measured. So when we talk about our growth versus value exposure, right? Those are factors that these tools may think about. Or if we talk about the size of the portfolio in terms of market capitalization on the equity side, right? Those are things that can factor in. On the fixed income side, credit quality is certainly an important component of that. When we talk about impacts from interest rate movements, right? Especially in the context of the yield curve, those also can be factors. Macroeconomic considerations can be factors, etc. But what makes this technology great is that it allows you to take any portfolio and get to a similar, common set of risk definitions that might be associated with your asset allocation scheme, your investment model, a combination of both, right? Depending upon how you build portfolios, and really leave it to the tools themselves to do all the hard thinking for you, right? And I think that's what's unique about that, Rob, is that it doesn't require for one to say, I need to literally look at the model weight and the deviation versus the model weight as my only definition of risk, right? It plays as an important component, but I almost kind of liken it to that. You could have somebody on 3 different diets that all still get you to 2,000 calories or so with the same contributions of protein, fats, carbs, etc.
Right.
Right. But how you get there might be a little bit different, right? And so, yeah, I think these tools they're phenomenal. They're great for advisors, especially with telling the story around what value they can add in terms of helping to also manage taxes in the context of kind of what they want to achieve from a risk standpoint. And I think, again, just kind of bringing it back in terms of like, what does that mean for credit overall as being represented in portfolios? Direct indexing has largely just been U.S. equity dominant, right? But I think now with the introduction of householding, it's certainly going to open the door for thinking about things more holistically, multi-asset, and a greater focus on fixed income within there.
One of the other things that I think near and dear to our hearts is I think about it from a credit events vantage point. Traditional credit and fixed income exposure can be well addressed in mutual funds and ETFs, passive or active. And if the client has enough assets and you've got an efficient trading partner, you can go out and buy bonds even. But there's this alternative sleeve, which is getting a lot of attention. And whether it's a trading style or a particular part of the bond or loan market that they want to access, maybe it's private issuance of credit, a whole bunch of different ways you can say that something's alternative. But one of the features that almost always comes with it, or not always, but frequently comes with it, is that there might be a measure of liquidity constraint. In other words, the vehicle that you might prefer to use to get access to it might not be daily valued or daily traded, frankly.
Yep.
How do you address that with the technology? If an advisor and a client say, look, this is meaningful to the way we want to shape this portfolio. We want 5% allocation, 15%, whatever it is. How does the technology address that when pretty much everything else in this portfolio construction environment is fairly liquid and daily tradable?
Yeah, so I think what's also kind of come up with the technology itself is really to outline your preferences with your assets when it comes towards any style of trading restrictions that you might deem are important or relevant for how you go about your more frequent rebalancing. And so, you know, I think the things we often see when this comes up, right? Certain clients, they're going to want to think about the representation of their household, not just simply with their publicly listed securities, but then also things like hedge fund related exposures, or thinking about their ownership in a private company, or private credit, thinking about their own real estate holdings. They may have a summer vacation home in Miami or Martha's Vineyard, all of those things, right? I think kind of what's fascinating with the technology now, we can represent them, right? If you own it, we can represent it, right? And so it really just comes down to from there saying, okay, hey, for this asset, how do you want to think about kind of the trade restrictions or preferences that may go along with that in order to accommodate the fact that, hey, might be not liquid today, but at some point, if I do sell that home, like I should absolutely consider, well, what's the tax implications of selling that home and those proceeds for having that reinvested in my portfolio in some way? And so, I think that definitely kind of creates another additional opportunity for advisors to kind of provide really unique insights to their clients that they previously haven't been able to.
Well, Joe, fascinating to see the evolution of the technology. I'm really excited about it. I know your firm is really, really active in bringing this kind of stuff out to the market space. We ask everybody that's on credit events, kind of a market prognostication. What credit event do you think listeners to the podcast should keep an eye out for here in the balance of 2025?
So I'm going to state this relative towards March 13th, which is today's date.
Yeah, which is today.
Which is today. I think obviously we've seen a lot of efforts, right? Certainly with the focus on cost cutting, for federal spending, things like that. One thing I would say would be interesting to see if it does develop over the next couple of days is possibly even a technical default by the U.S. government, right? If that was to come to pass, where we don't pass a continuing resolution on the budget, we don't get to any agreement in relation to kind of funding the government for most of 2025. I think that certainly will kind of permeate its way out towards, the real economy, both in the way of, how people think about kind of their expectations with growth in the markets, as well as just, everyday businesses, right? Being able to, get access to credit and draw on credit facilities. So that's something I think for, a lot of folks out there that, could be something that comes into focus. It's been a long time, probably since, last time I really remember something like this being a big deal. It's probably more so 2011 or so. But, I think that's something I would say just be on the lookout for. Yeah. Anything is possible. So
great insight. And let's hope that doesn't come to pass. All right. Well, listen, Joe Smith, CFA, co-founder of Parti, Pris, thank you so much for being on Credit Events. We really enjoyed it. We'll look forward to having you back again.
Yeah, looking forward to it too, Rob. Thanks again.
Thank you.